The idea of passive income sounds fascinating to some people. Passive income means that you earn money without doing an actual effort or work. It is the opposite of active income, in which you trade your time to make money. If you don't have some good sources to invest in, you have to earn an active income first. It is a harsh reality that there is no direct route to earn passive income unless you were born in a wealthy family and have a tremendous amount of resources to invest. It means that you have to earn active income to generate passive income and enjoy your income without actually doing work and spending your time. Now, investing in dividend stock to generate passive income has been around for quite some time. Passive income has many benefits without any doubt, but several things need to be corrected to benefit this money. In this video, we will help you to earn passive income by investing in dividend stocks. So, please stick with us till the end to get complete information about the cause. Where to invest now? It is essential to consider that not all companies give dividends. Some companies pay compensation, and some do not, like PepsiCo pays a premium, and Facebook does not pay a dividend. The companies that don't pay dividends reinvest this money to better profit from it and grow their store faster. So always take a good knowledge of the market before investing your money. You can also search about stocks online and learn about different companies and their investor resources or investor relations page. It will help you a lot. Always try to buy as many shares of the company as possible because many companies pay dividend payments yearly. Many companies are enormous and have excellent cash flow. Once you construct a dividend portfolio, you have to look after it instead of leaving it as it is and going on an extended vacation. 1. Payout ratio. Checking the payout ratio of dividend by the company is a crucial step. It is the proportion of earnings a company pays to its shareholders as dividends. If you are new, then most probably no one will advise you to look at these financial metrics. So, you have to take caution in this regard. A high payout ratio is usually excellent but doesn't let these high payout ratios fool you. A company may show a high payout ratio to attract investors. After they buy the share, the company would whether slash that dividend or increase their stock price because they are paying so much money to investors as dividends as they are unable to invest back in their business. 2. Stock price. Something else you might want to look at is the stock price of a company. Let us consider a case of two companies, and we name them as A and B. Company A pays a 6% annual dividend, but the company's stock is losing 4% each year over the past 10 years. So your total gain is 2% because the company is not growing. After all, you are getting a high dividend, and the company is declining. On the other hand, Company B is paying a 3% dividend, but it grows at a 4% rate. So you are getting 7% from this company with a smaller tip, but the company's stock is increasing, which is an excellent example of how dividend and stock price works. 3. Price to earnings ratio. While investing for passive income, this is another important financial metric that experts consider while trading. It is essential for investors who invest in blue-chip stocks that have not fast growth but have more well-established companies. If you want to invest in this kind of stocks, you have to take a closer look at price to earnings ratio, or simply P/E. A higher P/E ratio indicates that the cost of the stock is very high relative to earnings, and a lower P/E ratio suggests that the price of the stock is low relative to earnings. One way to check this ratio is by comparing it to the average market. Now keep this in mind while investing in any company. 4. Long-term investments. Long-term investments are usually better than short-term investments. The reason is that in long-term investments with dividend stocks, you can have substantial tax benefits from it. With a lot of dividend payments, investors see long-term capital gains. That is why the rich people make long-term investments and gain high money from it, as Warren Buffett says that he pays less in taxes as a percentage of his income than his secretary had. He has invested billions of dollars but has paid less in taxes. 5. Actual income from dividend. So how much money can you make from dividends? Is this sustainable, or is it something you can get rich and earn a good livelihood? You are making 3% from the dividend payments or some stock growth or any other factor. But here, we are talking about the actual cash that is coming into your pocket. If you have very little investment, you will earn a minimal amount of money, but it will surely benefit you if you invest a large amount of cash. There are always some moments when the market declines. You will face a challenging economic period and harsh times to give you depression. You have to be very careful about this. 6. Reinvesting dividends. Now, this may sound awkward, but you should reinvest your dividend back into the company or into various other companies if you have no financial issue. It is the key to find success over the long term. Instead of taking these dividend payments and spending them on your personal needs, you should reinvest them. Earning passive income from dividends is a long-term game. It is not something that you jump into and get out of it with a few bucks of money, but it indeed has the potential to make you a millionaire over your lifetime. 7. Dividend traps. One thing you need to make sure of is that you don't fall into the dividend trap. In this case, companies become popular as more and more people invest money because it produces a high amount of compensation. As the number of investors increases, the company feels pressure to pay dividends to its investors. The dividend trap is where the company's financial state is not good. In this situation, experts advise not to pay dividends. Paying these dividends will hurt their own company. No matter, you will get compensation, but at the stake of decreasing the company's stock price. Anyhow, in most cases, companies try to pay dividends to make their investors happy. To watch for a dividend trap, you have to check that the company has a low debt or no debt at all. The other thing is to care for positive cash flow. Therefore, experts advise not to believe anyone when it comes to your trading. 8. Risks in dividend stocks. There is always risk in business, and you have to accept and learn to take risks because it is the only way to become successful. First of all, there are taxes. The taxes are applied when the company paying the dividend earns money. Secondly, the investor has to pay tax again when they receive the reward. There are investment risks because stock prices can go up or down. As time passes, the company can make such policy changes that may be harmful to the investor. The company may be harsh to its investors when it faces bad economic phases. It may reject to pay the promised amount. The company can also reduce its premium, and these types of decisions may reduce the company's stock price. The investor should have proper knowledge of the market, and they should analyze these dividend stocks. If you want to earn passively, you should take care of your portfolio and check it daily. You should prepare a proper plan and execute it correctly. Dividends are very beneficial and can make you a millionaire. On the other hand, they can also burn all your savings, and you may lose all your money. If you're interested in more exciting and informative videos like these, please consider subscribing to our channel.